Welcome to 6 for June 25th, 2018. We are broadcasting live on YouTube, but all timing videos are now also available as audio-only podcasts. Your podcast. Also, as of just a few minutes ago, I was approved for Spotify, so all the shows should be on there as well soon. Today we will be discussing the 248th weekly crowd forecast news report, which you should be seeing the PDF version on your screen right now while I'm talking. If you haven't had a chance for it yet, you can go to TimingResearch.com/reports to find links to the PDF or blog post versions of this and all the past reports. My name is David Kosmeter. I'm the creator of TimingResearch.com, and I'm back to moderate today, so I'm going to go ahead and turn it over to him.
Thank you very much, Dave. And thank you for asking me again to moderate today's show. With all the market movement that we're seeing today, I think today could be a very interesting discussion amongst our panel today. And we have Glenn Thompson, Jim Kenney, and Lance Ippolito. I'll try to keep it in that order, guys. And so first, let's do a round of an introduction. And we'll start with Glenn, but just give us an idea of who you are, where you are, and what you do.
Right. Thank you, Michael, for the intro. And good to be back again, David. Yeah, I work with Pacific Trading Academy, and I've been there since the beginning with them. That's going on 15 years now. I've been trading over 30 years. And my approach is technical primarily, but you know, I look at everything, but focus primarily on the charts. As far as my day-to-day activity, I teach general technical analysis. My subspecialty is market timing. So that more or less is a quick overview of how I locate trades and what I do. Yeah, I've worked with beginners, experts, everything in between. Yeah, I'll let that stand.
Okay, great.
Pretty much
Thank
it.
you very much.
Sure.
Jim.
Yeah, I've performed the content for OptionProfessor.com and have done for many, many, many years. Basically, Option Professor is an education firm explaining the uses and the risks of all the different option strategies from beginning, intermediate, and advanced, as far as cash flow creating strategies on the options, as well as limited risk speculation and rolling positions and spreads and two-sided trades like strangles and straddles. And then very importantly, especially on when you see it rain like this, knowing how to hedge your positions using options, either puts or collars. Obviously, they'd be coming in handy when it gets really volatile like this. But obviously, it's always best to buy your raincoat before it rains. But at least if you know where the raincoats are located, you'll be in a better position. So that's what Option Professor is all about, not telling you what to do as much as telling you the menu that's out there, and then you try to use the right strategy at the right time.
Very, very good. And you're absolutely correct. Buy the raincoat before it starts to rain, because right now it's pouring. And we'll move on to Lance.
Hey everyone, I'm Lance Ippolito. I run a website called TradingCoachLance.com. I have a private Twitter feed with trade alerts. I focus mostly on options and straight calls and puts. With the specialty is I find unusual stuff in the options market. I have a scanner that probably spits out thousands of trades a day, and I try to out of that, thousands or so trades a day, try to find between 4 to 5 setups a day from day to swing trades in the options market. And unlike a lot of people, my winning percentage is very low, but I like hitting home runs. So I trade earnings events, I trade mergers, acquisitions, some technical breakouts, but I like to find stuff that's fishy in the options market, piggyback on the whales, and then hopefully try to hit those home runs. I also do some weekly options trades and your normal day trade stuff like that. But mostly people who come to me want to grow their account quickly, and that's what I've kind of done over the past few months, especially from a large account back down to a small account, starting all over again. trying to hit big winners in trading. So if you're into base hits, I'm not the guy. If you want to find that next merger or try to make that 500-600% on options, I'm the guy to come after.
There you go. Thank you very much, Lance. And once again, my name is Michael Filighera. I am the proprietor, the owner of LogicalSignals.com, which remains in a constructive phase. I'm redoing quite a few things and just haven't really gotten it together because I have other projects going on at the same time. I have traded options as a market maker here on the Pacific Exchange in San Francisco. I've also traded on the London Traded Options Market, the European Options Exchange in Amsterdam, and then finally I was on the Deutsche Terminbörse, which is actually located in Frankfurt, but I traded electronically through when I lived in Amsterdam. Coming back to the US, I did go back down to the options trading floor here, but then moved over once things started to slow down and go more electronic to my home office, and then eventually over to trading futures. And what our focus is right now, which I think may tie in very neatly with the questions that we have today, is managing risk management, being a good risk manager with your own money. And I think that we have a great panel to put some of that discussion to good use for today's audience, for today's show. So why don't we just kind of jump right in, and we're going to try to keep that same order. So it'll be Glenn, Jim, and then Lance. And let's start to go through today's questions. And question number one is, which direction do you think the S&P 500 index will move from this coming Monday's open to Friday's close? So it's June 25th to the 29th. And I'm going to start with Glenn.
Sure. I expect we will continue what we're seeing today through Friday and go lower. And I know there's a subsequent question as to the reasons, so I can elaborate, or but general trend I expect to be down and persist. Okay. And there are a number of factors I can cite later, I guess. Okay.
And yeah. So we should actually combine question 1 and 2, and sorry about that. So
sure.
And actually, we'll get to the reasons, and I look forward to hearing that from you, Glenn. But question 2 is like, what rate your confidence?
80%. That's not, I don't know that I've ever all the months I've I'm very confident. Especially given today's trade. I didn't expect to see this big a move today up, but in retrospect, I'm not surprised. So yeah, I think this is probably the highest confidence level I've had, regardless of whether it's bearish or bullish. But in this case, I'm bearish.
Right.
Yeah, and 8 on a scale of 1 to 10. Yeah.
I like it. I do like it. And Jim.
Yeah, I would say that with this kind of momentum, it'd be hard to just say it's going to turn on a dime and go straight back up. So the probabilities are definitely favoring continued further down. It's coming out of an extremely complacent period of time. Yeah. And so that's one of the main reasons that there could be more to follow. Having said that, if you're an aggressive trader, that 2,700 on the S&P would be a line in the sand to try to work against. And the VIX, if you're an option guy, the VIX at the high today at 1961 was up 42% today. So if you're a believer that the 15 is an equilibrium on the VIX, and when you get down to 11 or 12, the market's going to drop like it's doing now. And when you get up near 20, which it did today, the market's going to stabilize and rally. That might be a reason to fool around with the long side using something like 2680, 2700 as your line in the sand. Because again, the VIX did jump in a very parabolic way, and it's not at the high any longer. So if you're a very aggressive trader and you want to, step in front of the freight train a little bit, 2680, 2700 would be the neighborhood, and 20 on the VIX would be the neighborhood. And so we're kind of in that neighborhood. And but as far as probabilities are concerned, the probabilities is that the momentum is down and it's not going to turn on a dime.
Granted. So what type of confidence level are you?
Yeah, I would say it's obviously in the 55-60% probability that it would go down. But like I say, if you're an aggressive short-term trader, when everyone is getting out, somebody's buying. And if it's, market makers and people who've just dropped the bids because the volume is just like a tsunami today, and they're not going to step in front of a tsunami unless they drop the bid down 10% on these stocks, or 5% on these stocks, which they're doing. Obviously, somebody's on the other side of all this selling, right? And so with the VIX jumping towards 20, with the market hitting 2,700 and bouncing off, if you're an aggressive short-term trader, this is the kind of stuff sometimes you have to step in front of if you want to make some money.
Very well stated. And Lance?
People laugh, I'm a permeable. I think everything goes up, which has worked out pretty nicely. But I'm actually leaning to the downside I'd probably go right around that 80% move for the end of the week, or confidence level that we continue to move lower. Kind of the reason why I follow the options market all day, and over the past really Thursday, Friday caught my attention. There was very, very light call buying. A lot of the positions, it looks like, were either closing or call selling. Call selling, above or above at the money or out of the money calls is a neutral to bearish strategy. And then really today and all this morning, I've seen massive call buyers and VXX, even UVXY, which rarely sees option activity. A lot of hedges. Now, again, these are hedges in your big stocks like Microsoft, Intel. So I'm not saying the option players are always right, but judging by the option flow, it looks to be we're not going to see a bounce, at least short term. I really haven't seen anyone come in and step up to the plate and buy large, let's say Apple or Facebook, or dip buy Netflix calls or something like that, giving me an indication that possibly the Qs or something like that will turn around to the upside.
Well stated. And so for me, I am also an Elliott Wave analyst, and I'm sure that there's other folks on the panel that also probably take a look at Elliott Wave. And right now, it does seem to be dropping in what would be an Elliott third wave, and that's within a little bit larger decline. And if that be the case here, then I do not think that 2,700 is going to hold it. I think that there's a very high probability that it will get itself down to 2,675, which, again, we're talking 25 S&P points, which could be quite a large move. And being within the third, it certainly is in the realm of reality to drop there before we would see a bounce. So I am going to also go with lower, and I'm also going to give it that 75 to 80% probability that we will see these lower levels. Now, when that bounce actually comes, it's a little bit too hard to see right now when this is going to come, because there's a lot of internal building of these structures, coming off, that we may have an up day. So tomorrow might be an up day, and then Wednesday down again, Thursday up. But I do not see those up days really overtaking the downside here. The amount that we've dropped continues to indicate that we will continue. But as we know from trading as long as we have, nothing goes straight down or straight up. It builds, and it's always within recognizable patterns. But I am going to go down on the week, and I am going to give that a 75 to 80% chance of actually coming to fruition. Now, we have actually the responses from the survey this week did indicate that 55.3% do consider that the market will move lower or close lower on Friday than it did on last Friday. But 44% do, almost 45% consider higher. So I think that we're leaning a little bit more towards the downside. And then their responses were, the average was about almost 65%. Gave that their confidence level was 65%. The higher responses were about 63, and the lowers were 66%. So I think that the lowers are going to have their way today. But moving on, question number 3 is, for your answer to question number 1, please share what specific reasons you think the S&P will be heading in the direction that you chose. And the higher respondents were saying good economic indicators, like gross national product. And they stated that it could go up with Donald Trump in the office. Okay. Traditional end of quarter window dressing, especially after the down week last week. It's like, that may not be the case. And then, yes, a lot of people were, actually somebody said Elliott Wave was going to be part of it. The lower respondents were kind of looking at the continued profit taking at the end of the strong earnings, the downtrend continuing, the FANG within the NASDAQ holding up the market, and which kind of was true. And the SPY nearing oversold territory. That would not mean lower, that would mean higher, but that's okay. And actually Trump tariffs. So I actually do see this escalating trade war really going to tackle what we do in the markets. I think it's really going to knock the wind out of a lot of people's sails. So let's kind of go round robin here, and we'll start again with Glenn on any backing evidence or things that you'd like to say in support.
Yeah. Like you, Michael, I do take a look at the wave structure. It's one of the, I guess, analytical models that I think are helpful sometimes. If you look at the S&P, the top on January 29, I have a slide. I think my count may differ from yours, but it may not. I'm not sure what magnitude or degree you were referring to. I think you said we were in a third wave. But if in a macro sense, if I look at everything from the top on January 29, I believe we're in a bear market. I think that top corresponds to the end of a particular fifth wave, and everything to the right through today corresponds to a bear market ABC correction, although I don't think it's an ABC. I think it's a triangular correction. Triangles have 5 waves. And so what I did was I calculated the magnitude. Typically, the alternate waves tend to be bear a 61.8 Fibonacci relationship. But if you look at the top from last week on the 13th, which was 2 weeks ago, not yeah, today's Monday the 25th. But if you look at June 13th's top, I believe that is the end of a particular internal wave of a longer term macro triangle and the start of the next wave down, the final wave, the E wave of a triangle. Curiously, I had projected a turning point on June 14. So given I typically allow for 1.5 to 3 days of accuracy, plus or minus. And so I think although it's not perfectly accurate, it was close enough for me. And I expect so I'm not surprised that the market actually turned on the 13th, even though I guess my forecast was a day late. My next time point is projected to be July 11. So what that says to me, am I seeing price action given if working on a starting assumption that the current trend will persist until it reaches the next point where I expect there's a higher than average probability for some type of change. In this case, what I've projected already is coming in about 2.5 weeks from now on 7/11, July 11. So to your point, I agree. Markets don't rarely go straight up or down. 80% of the time, there's back and forth. You have a surge, you have a retracement, and that's mediated by long-term and short-term traders. But that's the primary reason I have the confidence that I do that we're going to go down between now and July 11. So this is just this is the first week of that 2.5 week window that I anticipate the net trend will be down. Even though fundamentally, I think, what is it, Thursday, we've got GDP. I think I also agree fundamentally that whether it's real or just perception, the escalating tensions on the trade front are negative. We might even see by the end of the week the net synopsis of all the fundamentals might seem to be positive. We might get a good GDP number. Consumer confidence, I think, comes out tomorrow or Wednesday. I'm not sure. But overall, what I go by is, what is the current trend? Where is my next projected turning point? As a starting assumption, work on the idea that what's ever in play is more likely to persist unless you have an overriding amount of countervailing forces that are going to create a turn. I don't see that happening, as I said, until July 11. So that happens to fit nicely and reconcile with my wave count, which I believe that final wave of the 5-wave A, B, C, D, I think we're in an E wave of the long-term triangle that began with the top on January 29. And I have a price target, a number that I've worked out to come in at, I forgot my number. Hold on, I go to my chart. 2639. So overall, that's my optimal price target, and my run time again is 2.5 weeks. 2639 is the target. I'm not saying we're necessarily going to get there, but we could. And that's actually about 61.8% of the move down from the top on March 13 to the bottom of April 2nd. So the question that presents to me is it reasonable that we could get in that vicinity, 2639, in the next 2.5 weeks? And clearly, qualitatively, it is. And so what I'm going to do now, and it also fits the wave count that I have. So that kind of predisposes me to look and see what events are occurring and brewing up on the surface fundamentally. What's going to happen day by day, week by week, moment by moment. So that's my primary factor. We had pretty much the market respond within 1 day to my previous time point of June 14. It came in actually on June 13. My next one is 2.5 weeks out. So far, so good. When we took out with today's trade the bottom of support on June 19th, that was a good indication the inertial momentum will carry this way for a few more sessions, and then we're going to see back and forth. I agree, but overall, yeah, that's my primary argument.
I do agree with what you're saying, but just before I move
Sure.
to on to Jim, I want to ask one question.
Sure.
And so that listeners can get a little bit of an idea of what we're talking about here. If indeed this is an E wave of a triangle pattern, then your expectation is that once it does get into your zone at 2639, that your expectation, if that is going to be the end point, is that the market will then thrust higher.
Correct.
Out of the triangle.
That's the end of an 8-wave cycle. And as such, by convention or default, it should start a new cycle, a wave one, taking the market higher.
I just wanted to make clear that the expectations, because also being an LU8 analyst, we have to realize that the expectation after a triangle is that once it's complete, the market will thrust in the opposite direction out of that triangle.
Correct.
And the first mark would be basically almost the breadth of the triangle.
Correct.
So we could really see a strong rally if this indeed is going to be the preferred count.
As such, longer term, I'm quite positive and aligned with a very strong price support. Again, going into the end of next month, commensurate with my projected time point. Yeah.
Yeah, that's really good work, and that's very good commentary. That was really good. I thank you very much.
I think, fundamentally, what we saw with the central bank the other week, obviously the quarter-point hike was discounted to a large extent, I think. But I think the question mark in traders' minds and analysts' minds going forward was, to what extent would they at least intimate whether we're going to have an extra scenario. Now, I'm not completely clear, because I think there's a less than ideal coordination between what's going on fiscally and the monetary policy. But the chart going back to the chart, it clearly does indicate, after we get out of July, significant advances in equity prices in the U.S. Yeah.
Great. That's good stuff. Thank you very much. Jim.
Yeah, basically on the on the broad strokes, the run up in January up to 2,900, 400 points above the 200-day average, clearly a parabolic blow off, and we've been going through the process of a trading range that is working off all the excesses, and we are definitely have worked off most of the excesses from that big parabolic move. Basically, I would be thinking along the lines of, I mean, a lot of people that I listen to were heavy cash just out of this thing in the last few weeks. And, you know, basically when you hear pretty sharp guys who you think are sharp guys anyway saying, I've never had less money invested. I can't even remember when I was less invested than right now. That's not bullish. So that's why, you know, we are pulling back here, I think. But I think we'll be contained to the trading range that's been established, using about 2,500 at the bottom of the S&P, using about, you know, 6,800, 7,000 on the NASDAQ, 9,000, 10,000 on the transports. I think those are great lines in the sand still. And then basically, I think this month of July and August could be rough rackets. And by September, I think we could start getting a turn. And then in the fourth quarter, we could get a very sharp move to the upside. Maybe it'll be fueled by the fact that obviously the buybacks are going to be coming back in from all the corporations. The tax cuts are permanent, so people are going to realize that. Dereg and leverage lending is going to be there as well. And then, of course, you know, these elections coming up for the midterms. Trump is running around, and basically, I think what it looks like to me, he's basically running for office at every place he's going. And if the guy's name's Joe Blow from Idaho, he just wants everyone to know that Joe Blow is his guy. And when you vote for him, you're really voting for Trump. So if you love Trump, you got to vote for Joe Blow, even if you don't even know his name. And if you vote for the other side, you're voting for Nancy Pelosi, who loves MS-13. That's what he's saying, and obviously some people are buying that. So the bottom line is, if he can go around the country and get some kind of a red wave, and then the business cycle that started a while back, but he's accelerated, then the Q4 would be a very bullish time frame. So right now, you know, you got to hold on to your hats. You should have put your collars on during that advance. If you didn't think 2,800 on the S&P was going to break, that's the top of the current range. So if you didn't think 2,800 was going to break, then obviously everything from NVIDIA to Google to Amazon to Boeing to all the names, you know, that we love, right? You know, Micron Technology, you know, all of them. You could have put collars on up there. You'd still own your stock. You'd have a ceiling above the highs maybe, and at least you'd have some insurance. So when it's coming down, you know, your equity wouldn't be getting hit as bad, and you'd be able to ride through the wave without the Maylocks that you might have to start downing. But, you know, my view is like I say, a couple of, you know, summer doldrums, right? And, you know, backing and filling into the trading range. And then by September and into the fourth quarter, then the cards may come out a little bit better.
Very well stated. Thank you, Jim. And Lance.
The one thing that I'm a little shocked no one's mentioned, I never hear anyone chat about really, is, you know, why I'm thinking the S&P continues to move lower is if you look at global markets, you know, some of the indexes, China, the DAX, especially the DAX is just really breathtaking for me. Is, you know, these names have seen outflows. I think Europe has seen outflows for like the past 6 months. If you look at the ETFs or the money flow, I don't get how, you know, I say that now, but I don't get how, you know, we can continue to move up. If you look what's been carrying us, obviously the FANG names, you know, propping up the NASDAQ, they just made new highs recently. And, you know, I look at that and I say, you know, are we really going to be, you know, divergent from, you know, global markets and just everything is, you know, perfectly fine while you have, you know, China in a bear market, you have the DAX just, you know, continuing to hit new lows. You have European financials that are just, you know, a very dark cloud, and they have been before the recent move in Deutsche Bank lower. So that's kind of, you know, looking at it and, you know, do we see a big bounce in global markets and the S&P says, all right, well, now this is the next leg up? Possibly, but, you know, I really haven't seen much. that's going to give me confidence to say, the green light is on again. Maybe it's once we start going through some of these elections and stuff like that, we have a little bit more attention because now we wake up, trade war, stuff like that. It's a new headline every day. But looking at the core names, maybe we have to wait till big tech reports earnings. Maybe we wait for global markets to start moving up. I'm really kind of just sitting on my hands at this point.
Okay, thank you very much. I very much like what everybody has said thus far, because I think actually when we're all coming from a little bit different viewpoint of how trade is and what actually stimulates or hinders trade, we're all coming to the same focal point where we do see that the markets do need to kind of pull off here a little bit. They do need to kind of come down a little bit. Maybe their equilibrium will be found down below 2,700, maybe down as low as 2,500. I do not disagree with anybody's analysis as stated. I think what we're doing right now is we're trying to just fine tune that, because from where we're sitting, we're 100 points away from the 2,800 level, but we're 200 points away from 2,500. And we're at least 100 points, well, of course, 100 points away from 26. So where this actually is going to slow down and stop, I think is really going to depend on what you're talking about, Lance, and some of the things that Glenn is speaking to, and some of the things that Jim is speaking to, because we have so many individual traders in the market. I also want to add into all of that a lot of the gyrations within the market right now are algorithmically derived, and they're driven by these same algorithms, which are the very large players in the market. Now, who makes the decision? I don't know. But we have to also understand that they could be driving it in a single direction. But I believe that, and for most cases, they are hedging an existing trade. So they do one side and they're coming in immediately and hedging that. And I think the basis on that is because of volatility. So I love the discussion about the VIX. I love the discussions about the individual volatility levels within our individual stocks. And so that's where I think that we've got to try to make the combination valid and understandable to all people that are getting involved in the market. Because as we've already stated, nothing goes straight up, nothing goes straight down. It gyrates, it goes up, it backs, it fills, but it eventually will reach its end point on both sides. What can help it along the way? Well, we know volatility can really spell out a lot of things. So I liked what I think, Jim, I think you were mentioning this earlier. You were talking about 20 on the upside and 12 on the downside there for market turns. And I think that's very valid. But now I want to add into it, where do we believe, and we don't necessarily have to do a round robin on this, but where do we believe that that becomes an invalidated thought in terms of what happens if the market drops below 2,500? What happens if the market drops below 2,639? What can we assume?
Then the plunge protection team comes out. The plunge protection team.
I'm going to say you're correct on that thought, Jim. I really am. But let's kind of move on. We can always come back and open up this discussion again. But I do want to get through our questions for today before we move back. Question number 4 today is an interesting one. And I think that we can personalize this to ourselves and see what we kind of can come up to or come up with. And question number 4 is, what are the most important trading or investing related lessons you have learned so far in 2018? And some of the answers thus far today have been risk management. In the world of options, research simple, not too many legged options, practice in sim trade or on the TOS platform, understanding the value of options, selling premium to see the value of covered rights. Yeah, okay. Protect your positions, limit losses. I like that one. Management of your existing positions. There are a lot of traps. Be careful. So again, just kind of taking all this, what lessons have each of us learned, if any, so far in 2018? And we'll go back and begin with Glenn.
Sure. I don't know that, Michael, I've learned anything new. I'd say this year's trades, again, collectively speaking, has served to reinforce some old tried and true principles that I've done well by through the years. But I think, in particular, the volatility, and I focus primarily on the equity, on the index, the S&P, and I do Forex primarily in my own accounts. But given the back and forth, the unpredictability, it has forced me to have confidence in the idea. Start with the charts. Now that's a technical view, and that's the view that I've adapted primarily. But the thing that the chart structure and interpretation does not give you, you don't have a confidence that a fundamental trader will have, because you don't have the explicit details. I can't, if you're not focused on what the VIX is doing or what earnings are doing if you're a stock trader. If you are, that gives you a modicum of confidence. You can see the cause and effect linkages, and things fall into place when they do. The problem I find with that is, number one, it assumes that you have a handle and an awareness, and you have a picture of all that's out there that's relative to the market or the instrument you're tracking. The other problem beyond that, that's by extension, is that's a big assumption. What about the factors you're not aware of? Whereas the charts, typically, I think, are going to give you you can trust, they're more trustworthy. The problem is you don't clearly see and have a precognition of what specific linkages will bring about the projection that they're indicating. And so that's why I think the best of all worlds is, I start with the charts, and then that more or less creates a predisposition for what type of generic events would fit and align with that. So coming full circle to the question, what lessons have I learned given this year's trade? I don't know that it's anything new. It just has served to reinforce, regardless of what the events are that could serve to toss you. One day Trump does this. By the end of the week, there's a resolution of the trade tariff talk, and China and the U.S. are at the negotiating table. Whereas at the beginning of the week, the market's in collapse, but by the end of the week, something new develops, and it's very difficult, at least for me, and it always has been, to try and second guess the collective market. Whereas if I go by the chart, which essentially, whether you're an Elliottician, whether you have market timing, whether you utilize oscillators, whether you use some Wyckoff, whatever models you use, they're not going to tell you specific details for any one instrument, but they more or less establish in your head, and what I like to refer to as an attractor. And attractor is just a general term I'm using to say that this market's going to be attracted to this type of trajectory. It may not align perfectly, but more or less, and that's where there's a margin of error. And as you see the things and the factors and events bubble up to the surface day by day, moment by moment in the world, news, fundamentals, with that fit that attractor, you can correspondingly have more confidence in your view. When you see deviations where you're seeing output or news releases or economic reports that don't fit your attractor, then you have to allow for the flexibility and thus the importance of money management. If every model, be fundamental or technical, if it had a perfect track record, there'd be no need for money management and risk controls and parameters. The fact that I'm not aware of anything, barring some type of alien technology, that's perfect, thus the need for money management. So again, I don't want to be too verbose here. I think what has been reinforced for me is just, in spite of being whipsawed or the news and what it leads you, start with the charts. And that's why I kind of embrace the technical approach, and then use that as your starting point, and then factor in all the other things. And it gives you a little more leeway. Yeah. That's
actually very good. And I think that's a great answer. Thank you very much. Jim,
I had a couple of reminders this year. One is that patience, especially if you're going to be working with a big chunk of money, you don't want to be sitting on things that have already had a big move, that are now going sideways, and where everybody is just, well, I'm going to stay in there. It's not going to go down long. When complacency meter, gets to over 100, and you've had a move up to 2,900. That's probably a time where you don't want to sit on a big portfolio of stocks.
Right.
And then if I listen to everybody and then I come to my own conclusions. But when I hear guys that I respect saying, I've never had more cash in my portfolio ever, well, that's certainly not going to make me want to hold on to all my stocks.
Right.
And then if I hear a guy, a bunch of people who are trading the 10-year note and it's 3%, and there's a multi-million-dollar bet that it's going to be at 260, 270 by August. Well, we're not going to be going to 3,000 on the S&P if the 10-year is going down to 270.
Right.
So, you listen to things, and then you basically look at the moving averages and you look at the charts, and then you say to yourself, hey, listen, what's the probability here? And if it ain't real high, you don't want to be in. The other thing is you got to be careful how popular things get. In the beginning of the year, I was tempted to load the wagon on 3 areas. And I'm talking about with, lots of money. Europe, emerging markets, and the banks. I mean, I was ready to put in like lots of money. And the stories made sense, right? Europe is cheaper than us. Emerging markets are growing faster than us. And of course, the banks are going to make a ton of money when interest rates rise. Wasn't that the story?
Yes.
Well, if I would have put a ton of money in there, I'd have less weight. It would be far under a ton, right? So the bottom line is I was reminded that you got to be very careful when things get extremely popular, because when they're very, very, very popular, that means participation is already there. And obviously, you got to remember, like on days like today, the whole world is negative and they're getting out. There's got to be a buyer on the other side. And if the buyers on the other side are professional market makers and guys like that, they're going to drop the bid to 2702, and they're going to take the VIX to 20. But if this is just a deal where people are saber rattling, we're already at 2716, and the VIX isn't at 20 any longer. So somebody bought it at 2702, and they're feeling better than the guys who are shorting it on weakness. So the bottom line is you got to be careful when everybody's doing one thing. There's got to be a guy on the other side, and if the other guy on the other side's a market maker who just raised the offer to a ridiculous price to get all the cattle in, or dropped the bid because there's a tsunami of volume and he's just not going to stand in front of it with his money unless he gets a really good deal, then you gotta be willing to say, hey, listen, not everybody's a genius, not everybody's a winner, and if everyone's running around on one side of the market, who the heck's on the other side?
Very well said. Very well said.
Those are reminders.
Yeah.
Like I say, this is a merchandising operation, stocks. It's buyers and sellers, right?
Right.
And it's volume, and there's got to be a buyer and seller on each side. And if the whole world's doing one side, the other side is going to just put up a price to give you something.
Right.
And obviously, when you get a day like today, there's a liquidity issue of some degree, right?
Yes.
I mean, you don't get this kind of a move because there's no liquidity. But don't forget, the guy also knows the volume may not be forever, right? So obviously, after this volume is all settled up, and if there's no more sell volume behind it, then it's going to bounce back, and that can happen. My personal feeling right now is if you break 20 on the S&P and you break 2,700, you'll get 100 handles off of this S&P probably pretty fast. So I would say this 27, 2680, 2700 area, and this 20 on the VIX. If you're holding on to stocks, you better, very much hope that those handles hold up, because I think if we break those handles, we could go into more of the abyssy type thing. But right now, we're not above 20. Right now, we're not under 2,700. So, that's not what's happening right now. But if you break those two numbers pretty substantially on the VIX and the S&P, then obviously going down fairly precipitously would be in the cards, because we did gap down today. And the old adage, what gaps down goes down, may come into play.
Very well stated. Thank you, Jim. And Lance?
Pretty much one thing, I always say it, but patience pays. I know we mentioned patience already, especially when you're options trading. Sometimes, you'll see your position go down, 50% or cut in half, and you're just like, ugh. So you close it out, and then you wake up the next day, and then, there's news or something, and the stock shoots up. So definitely patience and having confidence in your positions. And with that, sometimes, what I try doing, and I continue to try to do, is just walk away. Not stare at the screens all day, because usually when you're sitting there and you're staring at them, you get, you get the fingers that want to move and start clicking everything. And sometimes just getting away and walking away for the afternoon, going out to lunch, going for a walk or something is sometimes the best trade out of all of them.
Thank you. For me, some of the lessons that I've learned in 2018, and I'm just going to take a step back, is like, yes, I've been a long-term options trader, but I switched over and I am now more focused on day trading. So I don't carry, I do have core positions, but I don't necessarily carry a lot of positions overnight. In fact, when I'm trading futures, I basically carry no position overnight. And so within that realm, it's the lessons that I've learned is having to deal with risk management. And when I say that, I think that's like when you have a large account, your risk management is going to be opposite of what somebody who's coming in with a smaller account, and I'm talking small, like $5,000, $6,000, $3,000 to $6,000, that a lot of people are now coming into the market and determined that they're going to trade futures because they've heard a lot, they've seen a lot, et cetera, et cetera. Now, the lessons that one's going to learn real quick is risk management, patience, is where all the things that we've heard from, I think, traders that might have a little bit longer term vision in mind for their trades, we can squeeze down and apply to everything that we do. So we can apply those lessons learned to the smaller time frame, to the smaller account. And what I've realized is, like, because I've accepted a challenge, and my challenge is that I've been told, okay, you're going to start with an account of $3,000. And so I've had to take over some of my funds and I put it into a different account. And my challenge is to take the $3,000 and turn it into $6,000 in 8 weeks. Is it impossible? Absolutely not. So having to do that, what really becomes paramount is risk management. And people have to understand how to do risk management. And then it's position sizing. People want to come in and they want to trade a 5 lot because the market's dropping, because they see that, oh my God, I can make $1,000 or $2,000 in one trade. It's like, yes, you can, but your risk management's totally off. So I think that's like trying to teach people and help them out in terms of developing good risk management skills in any type of market. Now, the second thing that I've really learned in today's market is that you do not fight the algorithms. When they come in at a specific time, so it's really basic, down to taking a look at order flow. Order flow during a market, any market in the futures, is paramount to trying to get an understanding and a grip on when sellers are moving in, when the buyers are going to pick it up, and when they can become aggressive, and when they're just kind of they're just in there, they're going to buy a few and they're done. I think those are the lessons that are going to become very important to grasp, to understand, and to live by if you're going to try to trade these markets in the gyrations that they are now doing based on additional outside fundamental or technical factors. So we got to put that all together, and that's kind of what I'm coming around to doing. I think it's like when you're trading a large account, and even when you're day trading a large account, you have so much more room. Because if I can risk $5,000 or $6,000 or $7,000 on a trade because of the size of my account, well, that's not going to fit with someone who has to be able to risk, or just in terms of winners, losers, and during a trading day, being able to take small hits of $30 to $50 in the Dow, which is $5 a tick, so that you're alive when you can get and make that. So, and again, that's risk management. I'm going to risk 50 to make 150. I'm going to risk 100 to make 300, et cetera, et cetera. So I think learning these lessons and then applying them correctly, excuse me, and mastering them is very, very important. I'm going to open this back up to everybody. We can go like round robin, and we have about 10 minutes left. And if there's anything additional that you want to add, I really enjoyed the conversation about LE Wave. I enjoyed the conversation which we've all given today and how it is applicable to our markets. But if there's a particular trade that you like, or I think, Jim, you've already mentioned it in your introduction, that there were things to be done last week in advance of this move. And if you didn't, don't try to play catch up. I think that might be the underlying message as well. But let's do a round robin. If there's something that you want to add about how you trade, what you want to trade, et cetera, we'll go ahead and add it right here. And we will once again begin with Glenn.
Sure. Oh, headset popped off. Michael, following up on what you said, I liked when you said that sometimes there may be an urge, if you're not as experienced a trader, when you see a multi-sigma move, there's an emotional, might be even visceral tendency to want to jump in with a size that doesn't represent the particulars that define your account. And so you've got, it calls for discipline, obviously. So I always, because I teach, and especially with beginning traders, but also we're all human first. So even experienced traders sometimes will want to, I know, I'll put it on myself. I very often, I dislike the possibility of missing out on moves that I sometimes is more emotionally distasteful than actually net losses out of my pocket. So the way to offset that, or at least mitigate against those types of things, I always tell people, you hear about win-loss on this system or that system or this model or this strategy. In by itself, it's kind of vacuous. You need to combine that with reward to risk relative to the fund level or equity level that you're trading in the account. Also, to put things in perspective, I have a little formula. Your performance is going to equal your losses over your losses plus your gains. So whatever, you can look at that in terms of points, percentages, or nominal dollars and cents levels. It's a simple fraction. How much you lose over your losses plus your gains, and that's going to give you a performance number. So keep that in mind. So in other words, if I set my loss to the number 1, I want to have, in what you'll find in most treaties, and they've done studies for the last 60 years, you want to have a 2-to-1 or a 3-to-1 reward to risk, so that it's not going to take much to, and that, I think, when you see, when a trader goes through losses, a string of losses, and you see that you have this more or less structure in place where when you have a gain, it's going to be a multiple, minimum, say 2 or 3 times. That's going to possibly enable you to better refrain from doing things that you shouldn't do, jumping in with a size not in proportion to the funds you have to work with. So that, I just wanted to follow up on what you said, because that will, if you can keep that in the forefront of your thinking. To shift gears, I think for trades right now, I'm short in the stock market. What I'd be doing right now strategically, in a general sense, I'd be waiting for some little pullbacks, looking to identify zones of overhead resistance that are opportunities to, if you're on the sidelines, to establish a short, given my projection of continued expected declines between now and the middle of next month. So more or less that type of strategy is one idea that I employ. The specifics should reflect and be informed by the particulars. What if you have 100,000, or if you have 5,000 or $500, different strategy. I think Jim meant if you have less than 10,000, or let me put it this way: if you have less than 50,000, I'm not going to do futures or derivative. I'm going to probably play in an ETF and do some type of put spread strategy. So again, the specificity of strategy should reflect the level of funds. But I'd say a trade I like right now is going short in the stock market, one way or the other. I'm trying to think. I'm also long in gold. These are all position plays that I have in place. Right. and that's based on a price pattern that I've observed, and I think it fits well from an intermarket standpoint with my short in the broader stock market, the S&P. So yeah.
Great, thank you very much.
Sure.
And now we're going to move to Jim. And Jim, I really liked in your opening today, you were discussing collars and hedging, and whether it's a long or a short position, that hedge remains very, very important. So I would just like to ask if you wouldn't mind kind of going back and touching on that again.
Yeah, well, I mean, obviously, timing is everything. The best time to, as Bernard Baruch used to say, buy your straw hats in the winter or something like that. So obviously, putting your hedges on before the market rolls over is the way to go. And you have to have some beliefs. You know what I mean? Like what I was just mentioning about the VIX and 2,700. If you believe the VIX isn't going to blow out 20, and you believe 2,700 is going to hold, then those are your lines in the sand. If you didn't think 2,800 was going to get taken out on the S&P, and you saw a lot of frothy activity there, and I mean, you look at your statement, and it's obviously inordinately jumping on things. You know, the way you try to protect that sometimes is throw a collar on, which is an out-of-the-money call, and taking the premium and buying a put underneath. And then it puts parameters around your equity. You know, there are people out there who'd like to have parameters around their equity rather than just wake up every day not knowing what the hell's going to happen. But you know, right now, I mean, like I say, I'm expecting the winds of change to blow in the September through December timeframe. So I wouldn't want to blow a lot of money right here if I'm interested in stocks. I'd want to, you know, obviously let this thing do what it's going to do, and then I'd watch my moving averages. And once they start getting back above the moving averages, you know, that would give me some lines in the sand to work with. And so obviously, I think we're still in the back and filling stage, and that stage may last for a while because, you know, you got a guy as the president going around talking about these tariffs, and people are checking the math. You know, the trade deficit totally with Canada is not what it is on milk in Quebec. So, you know, there are intelligent people out there who actually put pencil to paper on people when they talk, and, you know, and then not all these countries are going to roll over and play dead. And the trade deficit, you know, frankly, I mean, our country is extremely large with an extremely large amount of wealth. And I don't know how a country like Canada or Germany or any country is going to buy as much stuff from us as we buy from them when we have 10 times the population and 10 times the money. So I think realistically, I think it's a crazy subject to think that we're going to balance the trade deficit when we have so many people and so much money. So, I mean, and I think people are out there doing the penciling now, and they're figuring out things, and this bombastic talk, you know what I mean, is causing this volatility. But by the fourth quarter, you know, cooler heads will prevail, or sensible mathematicians will prevail, and a lot of this stuff will be off the docket by then. And then, like I say, the fundamentals of what? Permanent tax cuts, deregulating the banks, you know, people still not making that much on fixed income. You know, all those things may come back into the market. You know, right this second, the most intriguing thing out there as far as, you know, where something is priced is the euro. At with the 115 price somewhat near the low, and the price of the gold in there in the 1250, 1275 range. You know, I think they're both on ledges. And I think if you saw the euro break through 115 substantially to the downside, I think that would cause a lot of volatility. But if it's not, you're staring at the low on the euro at 115, and by the fourth quarter, it might be totally differently valued. And if there is wage inflation that ultimately comes into the system, you know, that could hit the bond market again, and maybe it would get the gold off its dead rear end. But you know, I think the gold and silver with an 80-to-1 silver gold ratio, these are levels that if they don't hold, you know, then you could be looking at $1,000 gold, and you could be looking at you know, 100-to-1 on the gold to silver ratio if they don't hold these neighborhoods that they're in. And so I think the currency around 115 on the euro and the gold somewhere in this neighborhood, it could be interesting by the fourth quarter. but it's going to have the winds of change happen, which would be some wage inflation and some other volatile things going on, and maybe getting some of these currencies to go on a rally, and maybe these emerging markets would benefit if this dollar would come off this 94, 96 area that it's kind of banging into right now. So that's something right now that I find kind of interesting. But the other stuff, I think powder dry and get ready to, shoot the ball a little later in the year. I think that's really the best input that I can give.
Thank you very much. And Lance, again, you and I are going to have to be a little bit shorter because we're now running over. So, Lance.
I guess so really quick, for everyone out there, kind of, if you are worried about the market or your positions and everything, a lot of people may say, oh, I can't sleep at night, or, oh, what's going to happen? No one knows what's really going to happen in the indexes, right? It's a coin flip. At the end of the day, what happens? We could have news in 5 minutes and the S&P's, green on the day in the next 30 minutes. Who knows? But for everyone out there, know in your positions, what's your risk? So if you wake up tomorrow and a bomb hits, so-and-so, and the S&P futures are limit down, what is the max that you can lose, especially if you're trading options out there? And make sure you are comfortable with that, and accept that fact that, hey, if the whole world collapsed the next day, have that tactical advantage to say, hey, I know I'm going to be down this much, and then in the morning when it happens, this is what I'm going to do with my positions. So always know, what is your max loss on every position I put on. I say, what is the max I can lose? I don't look into it and say, oh, how much money can I make? That that's a fool's way to play it.
Thank you. I'm not going to get into any detail because I am a day trader, but I will say that the suggestions and the advice that has been given here today in this closing round is vital. And hopefully, if you've heard something that clicks, please notate how to get a hold of people through their websites and make contact. So I want to thank everybody. And also I want to thank David for inviting me back in to moderate today's show. And I'm going to turn it back over to Dave.
All right. Thanks, everyone. Great show. Just want to remind everyone watching, be sure to hit the YouTube subscribe button if you haven't yet to get updates on future shows. Also, just remind all the episodes are available as podcasts now through iTunes, Stitcher, or wherever else you listen to podcasts. Also, you can go to TimingResearch.com to get access to all the past reports and archives of all the shows. And be sure to join us tomorrow, June 26th, 4:30 p.m. Eastern Time, for the 40th episode of Analyze Your Trade. Larry Gaines, Stephen Place, Roy Swanson, Matt Buckley, and Oliver Schmalholtz will be on for that one. And if you've seen any of the previous episodes with Oliver, you know that he has a very fascinating news-related software analysis program that he uses. So I event with me for this coming Thursday about his software. So if you want to check that out, see what that's about, that's going to be Thursday, June 28th, 8 p.m. Eastern Time. And if you just go to TimingResearch.com, CPR.com, you can find out more about that. And just want to thank my guests again for this week: Jim Kenney of OptionProfessor.com, and Thompson of PacificTradingAcademy.com, Lance Ippolito, Lance.com, and Michael Filighera of Logical Signals.
Thank you, David.
Thanks, everyone.
Thank you. Thank you, David. Thanks.